1 minute past midnight Eastern, the last legal Iranian barrel cleared the books. The Treasury waiver that led in-process oil deals finished winds down today, July 17th, and the market spent yesterday selling the best chip earnings ever printed. TSMC grew profits 77.4%, and the stock still closed down 2.32%. That pairing is the whole show today. Energy closed on its highs while the Nasdaq 100 broke the exact support named in yesterday's video. My read: this is rotation. Money leaving the growth engine that stopped responding to good news and moving toward the sector with a policy floor under it. Today we watch that rotation either finish the job or fail at 6 very specific numbers. The charts are drawn. Let's work through all of them. Here is the record on the oil side. On July 7th, after Revolutionary Guard attacks on 3 tankers in the Strait of Hormuz, Treasury revoked General License X to the waiver from the interim deal that had allowed Iranian oil sales. Its replacement, X1, authorized nothing new. It only let transactions already in process wind down, and that window closes today, July 17th. Even the money from those final sales does not move freely. It lands in a blocked interest-bearing account. That is not a technicality. It means that from tonight, there is no legal path for an Iranian barrel, and no legal path for the cash either. The physical route was already shut in practice. Al Jazeera reported on July 10th that shipping through the strait ground to a halt as the fighting resumed, and the naval blockade came back into force on July 14th. So the deadline lands on a route that is already empty. Policy risk and physical risk now point the same direction on a date certain. Markets can argue with forecasts. They cannot argue with a calendar. Date certain, price undecided. Hold that thought, because the whole oil section comes back to it. Now the other engine. TSMC reported its second quarter on July 16th. Net income of 706.56 billion Taiwan dollars, up 77.4% from a year earlier. Revenue up 36%. Earnings per share of 27.25 Taiwan dollars. Gross margin 67.7%. That is a record quarter by nearly every line on the statement. If you had shown those numbers to anyone a year ago and asked what the stock would do, nobody says down. The market's answer: the stock closed down 2.32% at 4974, and chip stocks fell for a second straight day. Alphabet lost more than 4% the same session after Bloomberg reported a delay to Gemini 3.5 Pro. The session totals: Dow down 0.2%, S&P 500 down 0.5%, Nasdaq down 1.5%. Best print ever, sold anyway. That tells you exactly who is exhausted. The marginal buyer of expensive growth already owns all of it they want. Pull up TSM daily and zoom out first, because the damage has a shape. This month's high was 479. Yesterday's close at 409.74 puts the stock about 14.5% below that high, while the company was printing 77% profit growth. Price falling that hard against numbers that good is distribution with a name on it. Somebody large is using every bounce to leave, and they have been at it for weeks, not days. Now zoom back into the week. The floor is 403.50. It traded down to that price 3 separate times this week and held every time. 3 touches makes it a real level. The market has voted on it. Yesterday's close, 409.74, sits just above it. Overhead, there's a shelf of closes packed between 419 and 421, so 420 is the lid. That's a $6 box between the floor and yesterday's close, and a $10 ceiling. The stock is compressed, and compression at a triple-tested floor resolves violently in whichever direction wins. Here's the part that matters this morning. The overnight session indicated 397.53. That is, under the floor. An overnight print is an early vote. The decision comes from the completed daily bar. If TSM finishes today below 403.50, the strongest balance sheet in the chip complex has lost its week-long floor the day after a record quarter, and the pressure should spread through the group. If buyers defend it again, the floor gets a 4th touch and the lid at 420 is the next test. 4th touches are where the story usually ends, one way or the other. Floors that get hit that often either become launch pads or trapdoors. The Nasdaq 100 already made its choice. In yesterday's video, the repair level was 29,502.6, Wednesday's close. Yesterday, it finished at 29,025.77, below that line. Zoom out, and the slide has scale. The July high was 30,642, so the index now sits about 5.25% below it. That's a leadership index giving back a month of work in under 2 weeks. Next support is 28,814.57, the July floor that has held twice. Yesterday's low stopped at 28,881, about 66 points above that floor. So the market came down, looked at the level, and did not commit. Watch how it behaves there, because the pattern of a healthy pullback is a fast tag and a reversal, buyers waiting at a known price. The pattern of a broken trend is a slow grind into the level, a bounce that fails under the old support, and then the trapdoor. Yesterday's bar was the grind kind. Lose 28,814 on a completed bar, and the June range below opens up, and the rotation story gains a second act. Now the S&P, the referee. 4 highs in 9 sessions between 75.70 and 75.8150. That is a ceiling the market keeps testing and keeps respecting. The week's floor is 75.0402, and yesterday's session low landed exactly there before the close came back to 75.33. The whole 9-session range is barely 1% wide, while the Nasdaq broke down inside it. For scale, the index sits about 3.25% above its July low at 72.94, so the uptrend's cushion is intact. An index that holds its range while its biggest sector bleeds is telling you the money is moving, and it hasn't left. If the S&P loses 75.04, the rotation red gets dropped entirely. That would be distribution. Where is the money going? Watch the 2 energy charts. XLE closed at 57.02, up 0.9%, its first close ever above the old 56.50 ceiling in this range. And look at the shape of yesterday's bar. Because it is a textbook retest, it opened at 56.66, dipped only to 56.59. It never even touched the old ceiling, and finished near the top of the day. Old resistance held as new support without price ever needing to prove it the hard way. That is what demand looks like. Zoom out 2 weeks, and the rotation is even clearer. This fund has climbed from a low near 52.60 to 57, better than 8% in the same stretch the chip complex was bleeding. It tagged 57.30 twice this week and got rejected both times. 2 rejections at the same price is the market drawing you the trigger line. So the setup is clean, a daily close above 57.30, and this is a breakout with a policy deadline behind it. Fail back under 56.50 and the whole move was a head fake, and you will hear that admission on the next chart, not an excuse. Brent, on the live July 17th bar, has traded 83.71 to 85.50 and sits near 84.43, below 87.55, the spike high from the strike week that nothing has touched since. Zoom out and you see what that premium is worth. Crude ran from about 71 to 87.55 when the Strait shut, a 23% repricing in days, and it has surrendered very little of it since. The shelf underneath is 83.31, the close that started the whole move. Deadline day, empty Strait, and crude is holding the middle of its range. The premium is in the price. Whether it grows is decided at 87.55 and only there. And if 83.31 gives way while ships start moving again, that same 23% tells you exactly how much air is underneath. One quiet number ties the whole board together. The 10-year Treasury yield closed at 4.53, down from 4.56, drifting away from its July high at 4.64. The month's full range runs 4.36 to 4.64, 28 basis points, which is a calm bond market by this year's standards. The floor that is held twice this month is 4.45. While the 10-year sits in that band, the rotation math holds, yields high enough to pressure long-duration tech, stable enough that nothing breaks. A break below 4.45 would say the bond market smells slowdown, and that reprices every chart in this video. 4.45. Circle it. So let me put the whole board into one playbook for the next 2 sessions, because the 6 numbers only matter in combination. Case 1. Rotation completes. XLE closes above 57.30, while the S&P holds above 75.04. That is the market saying the deadline premium is being paid, and paid from tech's pocket. In that world, TSM below 403.50 is pressure, and the Nasdaq drifting toward 28,814 is rotation doing its job, while the broad index stays calm. Case 2. Rotation fails quietly. XLE slips back under 56.50, while the Nasdaq reclaims 29,502. Then the breakout was a head fake, the chip selling was a 2-day shakeout, and the whole story collapses back into a single oil range trade between 83.31 and 87.55. That outcome would be admitted here in plain language the very next session. Case 3. This stops being rotation. The S&P closes below 75.04 while the 10-year breaks 4.45. Falling yields plus a broken band is not money moving between sectors, that is money leaving. Every constructive read in this video is conditional on the referee holding, and the referee is a number, not an opinion. No case gets a prediction attached. The completed bars pick the case, and the levels were named before the fact. That is, the entire discipline this desk runs on. Deadline day in one breath. The last legal Iranian barrel is done at midnight, and even the cash sits frozen. The chip complex sold a record quarter, and TSM's floor at 403.50 is already being tested from underneath. Energy is one close above 57.30 away from a breakout that has a government calendar behind it. The Nasdaq needs 29,502 back to call off the alarm. The S&P referee holds the whole REIT together above 75.04, and the bond market stays quiet above 445. 6 numbers, no predictions. The completed bars decide, and whichever way they print, the next chart walks through it with you tomorrow. If a daily desk that talks in levels and dates is useful to you, subscribe. It costs you a click, and it keeps the lights on. See you at the close.